That's always the sign, recording in progress. Good evening, everyone. I am so happy that you're all joining us today. My name is Akshay Iyer. I am one of the wealth advisors on the team here at Sarwa. And today we're going to be diving into a very hot topic, navigating Trump's tariffs and what they could mean for your finances. Now, tariffs are back on the table, but also off the table. Volatility is up. Headlines are as dramatic as ever. But I think rather than panic, today's session is going to be a little bit more about perspective. And look, who better to give us that than Andrew Hallam? I'm sure everybody who's joining the webinar today knows who Andrew is. But for those who might not, Andrew is a best-selling author. He's written Millionaire Expat, Millionaire Teacher, Balanced. He has traveled all over the world, spoken to thousands of people about investing. And today he's here to help us kind of cut through the noise and really focus on what matters. Andrew, thank you for joining us from Bulgaria, right?
Yeah, thanks, Akshay. Yeah, glad to be here.
Awesome. I know usually when we have these sessions, Andrew, you're in Panama, you're in Canada, you're in the US, but it's usually bright and early. So I'm glad that we're on a similar time zone today.
Yeah, we're only 1 hour apart right now.
Glad to hear it. Awesome. Okay, so right before we get started, just a quick housekeeping note, a couple disclaimers. So if you came to today's session to find out what's going to happen with the market tomorrow, I am very sorry. I do not have that answer. Andrew doesn't, the famous Warren Buffett doesn't. And especially after the way things were yesterday, I don't think anybody has a clear indication of what's going to happen. And the second thing is this session is purely for educational purposes. Nothing shared today should be taken as one-on-one investment advice, but we are going to spend a decent amount of time in question and answer. So if you do have any questions about your individual circumstances, please leave them in the chat function, in the Q&A function. And if you also want to speak to us offline, feel free to just reach out to our team as well, and we can have a discussion. Awesome. So jumping straight into it, right? And really into the thick of what's been going on, right? The start of 2025 has been anything but calm. And I think for a lot of people investing and a lot of people joining the webinar today, they want to kind of get an understanding of, look, where are we and why have we kind of gotten to where we are? So Andrew, just wanted to pass it over to you to really just kind of discuss, right? Where are we and what does this mean right now?
Yeah, I think if everybody went to bed on December 31st and then you were told, hey, this is what happened with the markets or this is what happened with your investments, you wake up April the 9th, you'd look at that and you go, oh, okay, the S&P 500 is down like 6%. Uh, global stock index is down 4.37. If you've got a diversified portfolio that's say 80% stocks, 20% bonds, you're down less than 4%. And you would probably just shrug that off. You wouldn't see that as a big deal. So that's just like, that looks like just normal market movement. But as we know, we had a huge run up at the very beginning of the year, and then we had a big drop, and it's just been a yo-yo ever since. And truthfully, the idea here too, I think the most important thing is control what you can control. And one thing that you can control is your behavior. One thing you cannot control is the tariffs, is the economy, is the reaction that people have to the markets. And it's interesting too to note, Akshay, like many people really see the stock market as this separate kind of entity with its own life. The stock market is what you and I are doing. That's what the stock market is. So here's the deal. When more money is going into the market, I mean, more people are buying, stock market goes up. When more people are selling or more money is being withdrawn than is being added, stock market goes down. So what we're looking at is just natural human movement and natural human emotion, which, yeah, has always been crazy. Human beings emotionally have these wild emotional swings with respect to greed and fear. And as investors, that's what we need to conquer.
Yeah, and I think like this is normal. Markets rise, markets fall. It's nothing that we can control. It's what they've always done. And volatility isn't a bug in the system. It's actually a feature that long-term investors have to actually earn higher returns. But as you said, right, I think if you'd gone to bed and woken up 4 months later, this wouldn't be the biggest deal. But yeah. But what's been happening, obviously, is that it feels a lot more than that. Um, but I think for a lot of people, right, they're thinking, should I stop investing? And what would you say to that?
We have more than 200 years of history that suggests that if you can continue to add money to the markets whenever you have it, what will happen is over time, you are going to pay a lower than average price if you can just continue to add money. And the knee jerk reaction here, Akshay, is people will say when markets are volatile or when the market drops, they're actually afraid to add money. And you have to think of it, and I bring it back every time to a supermarket sale. When the market drops, the same things you were buying previously are now on sale. And markets always fall far further than they should. That's always happened. And we'll actually show you an example of that with dividend yields from 1929. And I'll explain how and why that's the case. And it is the case because short term, we are emotional creatures. And it's not about conquering the stock market, it's about conquering our own emotions and just continuing to add money. It's not about trying to time the market by pulling out when it's volatile and thinking we can put money back in, because then you're timing it on two levels. You have to be right about when you're pulling it out, and you have to be right about when you're putting it in. And generally speaking, that's a fool's errand. If you get lucky once with that, if somehow you time one of these swings and you start thinking that you or the person you listened to who suggested you do this has some kind of magical ability, you are going to walk back into that casino and you are going to try it again. And ultimately, you're going to get you're going to get something nasty handed to you on a platter.
Yeah, and you know what? You hear the stories time and time again of people who do try to do this and they think that it's, this is the right moment. But by the time, look, us as retail investors, like by the time you actually decide to go back into the market is the most efficient thing that there is. It's gone way ahead already. So you're always trying to chase that new high or chase that dip. And if you just miss a few trading days, I don't think we have a slide about this, on this presentation, but the importance of staying invested, just missing a few top trading days in the year can be so detrimental to your long-term approach. So I'd say, look, if
Yeah.
you're working, if you're earning, this is, as always, a time to add. Markets are on sale. And a tip, right? If your stock and bond market allocation shifts by 10% or more, it's time to rebalance. Look, if you're a DIY investor, but if you are using the invest portfolios, the Sarwa invest portfolios do that automatically for you. So you don't even have to think about doing any rebalancing. So in both scenarios, right, don't react to it based on what's happening in the markets. Base it on your asset allocation and your risk profile.
Yeah, exactly. And there's a temptation to think, well, somebody has to know. So I'm going to tune into somebody saying something online or somebody on CNBC. And the reality is, as retail investors, and that's what we often think that the professional investors are better at this than we are. And the reality when we look at peer-reviewed academic advice on asset allocation funds, so basically professional fund managers who can buy whatever they want at any given time. So if they think that, they don't have to stay in a specific lane, like they don't have to run, say they're running a mutual fund, or you have somebody running a mutual fund and it's a US large cap mutual fund through Fidelity. And that's the lane that those fund managers have to stay in generally. But an asset allocation fund manager can do whatever they want. They can put everything into cash. They can go all into US. They can go all into bonds. And so, in essence, they've got their thumb on the pulse of the economy, interest rates, they're looking at the political environment. And when we look at their actual results, compared to someone who just stays the course with a simple, globally diversified portfolio of indexes or ETFs, the person that stays the course destroys the professional asset allocation managers, even when we assume or make a deduction for the fees that they charge and assume that they have done this for free. It's much the same with hedge fund managers. We often think, well, they've got some kind of secret. So what are the hedge fund managers doing right now? It's the same thing. If you deduct the fees that they charge, you will beat the vast majority of these hedge fund managers just with that simple plotting technique of adding money whenever you have it to a globally diversified portfolio. And the hedge fund managers that knock it out of the park during one 10-year period or a 5-year period often end up pooping the bed during the next 5 or 10-year period.
Yeah, and another thing is, look, you're also going to be able to do it with a lot less stress, a lot more money in your pocket, and a lot more time on your hands. So that's usually the advantage of kind of looking at your portfolio a couple times a year, and usually that sets you up for success in the future. So the famous Warren Buffett, right? He loves a bargain. When markets fall, he buys more. When stock prices drop, right, Andrew, we always see people run away. But you want to see it, as you mentioned in the supermarket, right? It's a 50% off sign. And then you decide you're not going to shop. So this is, we wanted to share this with the audience just to give them an understanding of what this actually means.
Yeah, it's as I mentioned before, you can't control the tariffs, but you do know that human emotion, fear and greed will pull the stock market up and down. That's what does it. We do it. But if we're Zen-like and we recognize that lower prices for purchasers are actually a really good thing. So if you're listening to this right now and you've just started investing, or especially, you've been maybe investing for 5 or 10 years. So you're relatively early in the game. A stock market drop is actually a really good thing. You should actually welcome it, regardless of what you feel made it drop. A market drop is actually beneficial to you. You should much prefer, as Warren Buffett says, to see stock markets actually fall. So for me, I'm 54, so I'm probably older than the average person who's listening to this right now, but I still have an income. And I'm hoping that I live till I'm 90 plus, like Warren Buffett. It'd be great to hit 100. I actually really like it when the stock market drops, because when it drops, I'm buying assets at a discount and it will always fall further than is typically justifiable based on the fact that we are irrational creatures. And so it's a wonderful opportunity. When markets fall, you really ought to celebrate. And I think if you can rewire your brain to believe that and to embrace that, you're going to be a lot less fearful when stocks do decline.
Yeah, and I think psychologically it's always tough to get yourself around that. But I think with the more that the longer that you invest for, and I'll tell a story, towards the end also about how our sort of investors and the general investment population has reacted this time. It seems to be quite different, but I think a lot of investors just need to go through those cycles and then they'll realize, what it means for them in the future.
Nice quote there, right? Actually, conquering fear is always the price of admission for a stock market discount.
Yeah, I think for a lot of people, right, fear is normal. Yes, as it says, right, it's the price of admission for building real wealth, real sort of net worth. I think throughout history, from every, the Great Depression, dot-com crashes, COVID, what we've been going through before, right? Investors who kept adding to a globally diversified portfolio emerged with serious wealth, right? It says over here, in every global market drop in the past 200 years, if you kept adding money, you've been in a fortune time and time again. But it's going through those volatile times, that's the tough part.
Yeah, it's great. It's putting too much attachment. And that's what I think it is. It's actual psychological attachment to the current market value of the portfolio. And I think we need to think of that as an irrelevancy, because we really need to think long term instead of short term. Warren Buffett talks about a mischievous man called Mr. Market, and you do not want to fall under Mr. Market's influence, because it can convince us to do silly things, to speculate, to sell, to not add money this month because we think the market's volatile or the market's low and we think it will go lower. So we need to master our emotions more than anything else.
Yeah, so I mean, I think an amazing way to show people this is going back and looking at previous times that this has happened. So we've got a few examples over here. So Andrew, you've shared an example about 2008. Would love to hear, your perspective of this and what could have been, if you were investing in 2008.
This was a wholly global terror. And even people that actually lived through it, memories tend to be short. But to put ourselves back into that time and feel what was actually going on there, where in 2008, more than 104 huge US businesses declared bankruptcy. I mean, we had banks declaring bankruptcy. We had GM and Ford teetering on bankruptcy. We had Freddie Mac and Fannie Mae, which are the big mortgage lenders. We had AIG. We had just a whole slew of huge companies that were seemingly too big to fail that were failing. So US stocks dropped 47% from November 30th, 2007 to March 31st, 2009. And there wasn't a way to reverse that with somebody just saying, oh, I'm going to cancel that tariff thing. I mean, this wasn't something we could just turn around with someone speaking. I mean, the housing market collapsed, unemployment just soared, and the media, every time you went online or every time you'd open up a newspaper back then, the media would say that this is a global economic meltdown, which it was, but the media was saying we will never recover from this. This will be worse than 1929. So, there were so many people saying, if you looked at financial magazines at the time, and I can still picture one with it was a money magazine. It was one of the biggest selling magazines in the US. It was another one that same month when Forbes came out, and both of them had a really similar cover picture, and it was a stack of $100 bills with a lock and chain around it, and it said like how to protect your money. See inside, and it was all about selling your stocks, putting it into gold, putting it into whatever, guaranteed investment certificates at specific banks that maybe wouldn't go bankrupt. It was a really crazy time, but it was a fantastic opportunity. I mean, like, fear is always the price of admission. And if you recognize that, what, markets globally, they will always recover, and we don't know when. And if you have the nerve to just ignore it and just continue to add money, it gives you a massive future foundation for wealth. Even just the notion of, okay, continuing to add money and then the rebalancing process that you will do. So for me, for example, I had an investment portfolio that was stocks and bonds. And so the idea of I was selling my short-term government bonds and throwing them into the stock market. And the market was gyrating like crazy. There were so many times when we would get intraday differences with the S&P 500 that would go up and down 10% in a single day. And it didn't just happen once. So to say, oh, this kind of volatility that we have now, it's never been seen before. Trust me, it has been seen before. And if you can just ignore it, because you can't control it. You can't control the tariffs. You can control your behavior. And if you keep adding money, inevitably you're going to end up doing really well.
Yeah, and I'm glad you shared that nugget, right? Because it seems insane what's been happening over the last few days, but then you look back at '08, you look back even further, we got some examples. Perspective, it means a lot. And I think the greatest investment opportunities in our lifetime have often come from when things feel the worst, right? You look at what the gains have been following that. And look, if you had continued to buy, right? Let's say it's 2007, and you saw that money that you had invested, it plunged, right? All that hard-earned money for year after year. If you had invested that money and you looked at it from '07, November 30th, 2007 to March 31st, 2009, it would have been terrible, right? That's a long period of time. But then this is where the magic happens, right? You would have made an absolute killing. The example you have, right? Like, this is $50,000 invested in November 2007, adding $3,000 a month, right? Where would that leave you March 31st, 2025? $2.26 million. With all of those volatile periods that we've experienced since then, you had been in a great position. Not timing the market, not trying to enter and exit or do anything else. Just the simple act of adding money to your portfolio on a scheduled basis, regardless of what's happening in the market, you would have been in a fantastic spot today.
And it's just that, to your point, Akshay, when I was talking about the crazy volatility where it didn't just drop, it went up and down. There were intraday differences where a market would go up and down by 10%, then drop again by 8 to 10% in the single day. And we had several of those. And if you just kept your cool, it became the ultimate fertilizer. Just looking at that graph, can you guys see how steep that graph is in that first part when it started to recover? So you're adding money, and I was adding money to the markets, and my portfolio, it kept dropping. But I wasn't concerned about the market value at that point. I was more interested in, wow, what's the market value going to be in 20 years' time? It's going to be amazing. I'm going to keep adding money through all of the crazy. And just looking at that, you can see the steepness of that during the recovery, the steepness of that portfolio growth in those early phases when the market started to recover was huge, because I've used this example of a catapult before, but you are piling money on this catapult. And eventually when it takes off, as you can see on that chart on the left side of it, it really does rocket.
Yeah, and I think also something important to note, as you can see, right, like very sharp increase in the early years, having money invested at those periods of time in later years really solidifies you. So we have a lot of investors, right, who have, they've seen the dip in their portfolio, but their portfolios are still not negative over the last few days because they've been super diligent in earlier times when the markets were at lower levels. It's not like you're just waiting and investing only when times are good. When you invest in all periods of time, you take advantage of those lower price points. And when days like yesterday happen, even better, because when the market starts to shoot back up, you're in an even better position.
Yeah, it's interesting, Akshay. I remember, I know a lot of people are talking, I'm watching on forums, and they're talking about buying the dip, buy the dip. And it makes me wonder, do these people have cash on the sides that is basically being wasted for some opportunity to buy the dip? Here's what I say: celebrate the dip and buy whenever you have the money to buy, always, always. And some people will say to me, like, well, add more to the markets because things are cheaper now. And for me, I never quite understood that. For me, it was always, I add as much as I can to the markets every single month. So to be truthful, I was actually adding more, but only because I started taking on these extra jobs. So I took on more writing assignments. I took on some tutoring so that I could end up having a bit more money that I could throw at the markets. But I think it's pretty important that, if you're holding back, you're delaying your financial independence.
Yeah, and it goes back to what I was saying, right? You're missing out on opportunities at all points in time, because if you're just waiting on the sidelines, you could be waiting forever. Imagine you sold out in 2009. You could still be waiting today because there hasn't been a pristine opportunity. There's been just there's just opportunity all the way along the way. So it's very, very challenging to time that period of, that right moment. For the people who, advocate for buying the dip, I also hope it's not people pulling money out of their emergency reserve or anything like that.
Mm.
Have your personal finances set up in a very orderly fashion. There's a reason for that. Don't put your rent money to buy the dip. Don't put, your emergency reserve or anything else to buy the dip. If for whatever reason you have surplus money, think about if it makes sense to even have it in cash. And then if it doesn't, then obviously allocate that further amount. But I think we do have a lot of people who they always keep maybe surplus cash for potential investment opportunities, but always keep in mind the opportunity cost of that when it's just sitting idle.
Yeah.
So this is, you mentioned it before, right? The slide we have a little bit about how the Dow Jones Industrial Stocks were and the sort of dividend yields for them from 1929 to 1932.
Yeah, this is one of the points that I want to make here, and it may not be obvious from this chart, but I want to explain how the stock market will always fall further than it justifiably should from an economic fundamental standpoint. Likewise, it always rises further than it should from an economic fundamental standpoint, because people, we collectively make and base our decisions on fear and greed, and we only think short term. So we know that in 1929, you have right in front of you now, you have the years of the Great Depression. And we know that corporate earnings actually dropped, right? But if you look at the dividend yields here, so the difference between the markets between, like, say 1930 and 1932, yeah, it just did continue to drop. But look, the dividend yield of corporations almost doubled. It went from 4.7% dividend yield to 7.2%. And it wasn't because companies were paying higher dividends. They were actually paying lower dividends. But the prices had dropped so much relative to the corporate earnings. The corporate earnings in America did not drop 87% from 1929 to 1932, but the stock market did. And that is always going to be the case when people are fearful. And so were those companies truly worth 87% less 3 years later? No, they weren't. Yes, they earned less money. Yes, they reduced their dividends. But if you look at it on a fundamental level, they were probably worth maybe 35% less fundamentally when looking at the recession of their corporate earnings. But look then at the fact that the market itself dropped 87%. You guys, the market short term is not rational because human beings are not rational. And we have to remember that.
Yeah, and I think it's so important to look at the economy and the stock market, but these things are not, they don't actually follow each other. It's kind of insane if you think about it, right? Because if you look at the underlying fundamentals of a lot of the companies today are, we've seen solid earnings, even employment numbers are good, all of these things that usually will correlate with strong, equity performance doesn't necessarily always mean that's the case, right? The market is so driven by sentiment. And I think in this day and age, it feels like it even more because of how many things are going on and how many things that you're reading and seeing. But remember that that's not always the case, right? The stock market is not reflective of the economy and vice versa. I think, in this example, right, from 1929 to 1933, if you were investing in these companies, it means that you're actually just getting paid just to wait. Markets eventually recovered, and even during the crash, that money was still working for you. And I think a lot of people forget about the levers of owning stocks, but it's not just capital appreciation, right? You've obviously got the capital appreciation in place, but dividends also are paying you. Those reinvested over time, that is the sort of magical solution and formula to real wealth over time.
Exactly.
Now, this is a question, and Andrew, I've had the fortunate time of hearing you talk about this scenario where I think it'll puzzle a lot of people in the audience, right? And this is the question, right? Would you rather invest in a market that keeps going up or one that drops for a while and then maybe goes up later, right? What would you say to that, and how would you tell everybody in the audience about this example?
Yeah, look at scenario one. So in scenario one, basically we have an 18-year period. And over that 18 years, from 2025 to 2020 to 2043, let's say the US market gains 8.4% annually. And over the next 3 years, 2025, 2026, 2027, it jumps 37%, then 22%, then 33%, and then has a pretty solid 18-year average of 8.4% versus scenario two. Imagine 2025 market drops 9%. 2026, it drops almost 12. 2027, it drops 22%. And over this 18-year period, the average return of the market is 5.29%. If I ask you, which scenario would you prefer? If you're a carbon-based life form with a Homo sapien brain, you're almost all going to pick scenario one. You're going to say, I get immediate gratification from the market going up, and the time-weighted return, the actual gain of the market in scenario one is much higher than it is in scenario two. Now, those time periods actually existed, or those returns actually existed over two respective 18-year periods. The one on the left was 1995 to 2012. The one on the right was from the year 2000 to 2017. Now imagine you had $50,000 at the beginning of each of those respective time periods, and you added $2,000 a month for 18 years. Which scenario would have been better? This is the real mind bender. Scenario 2 would have been better. In scenario 2, you would have ended up with $1,187,309. In scenario 1, you would have ended up with only $924,579. Okay, people looking at this are just going to go like, what is going on? How does that work? How does the investor in scenario 2 actually end up with greater profits? Well, earlier in the game, you had some really big declines. What that did was it allowed the investor to pay a lower than average price over time. So although the market earned a lower average return over those 18-year period, the money weighted return of the actual investor who was able to continue to add money and had the nerve, especially early on, to keep adding money and take advantage of those discounts, that investor in scenario 2 would have made more money than they would have made in scenario 1. And so this is why we have to get our Neanderthalic brains aligned with the reality that if you, as Warren Buffett says, if you are going to be investing in the markets for at least the next 5 years, adding money to the markets for at least the next 5 years, you actually should be happier to see the markets drop. And now, always, there's something scary. More often than not, like I said, fear is the price of admission for discounts, always, whether it's a 2008, whether it's a 1929, or whether it's a Trump tariff thing in 2025. Fear is always the price of admission for this opportunity. But as we said in the beginning, 200 years of history. When markets drop, if we continue to add money and take advantage of those drops, eventually, when the global markets recover, we will make a lot of money and reap wonderful rewards from that. Go for it, Akshay.
And I think this is the test, right? For a lot of people in the audience, right? You're thinking, if you sell during a drop, try your timing, try to re-enter, chances are you're going to miss the recovery. But if you stay calm, stay consistent, keep adding, this is when you usually will pass the test. But not just pass the test, but you're going to thrive, right? I think there's two types of investors, or hopefully not, there's a lot more, but the ones that we're going to break it down to for this, right? Those who sell during a market drop, hoping to buy back later, it's a trap, right? It's like trying to jump off of a moving train and hop back on suddenly at full speed, right? How are you going to get back there? But there's also people who stay calm, adding, even when it feels like the world is ending. But history is clear, right? The second group has always historically come out on top. So that's always a question to the audience to kind of, and I think for a lot of people, it's they do find these times potentially nerve-wracking because it feels like to see that volatility in such a short amount of time feels very difficult, and we completely understand that. But what we wanted to do today was go back to some previous examples and put them into perspective, and look back at history and how it's really gone on over time.
And people will always say, well, this time it's different. Yeah, you're right. Every time is different. 2020 was different too. So that wasn't all that long ago. And you guys could hopefully be able to place yourselves in that. We did not have a vaccine in 2020. Businesses were shutting down. Global GDP went down the toilet fast. The only companies that were making money would be service internet-based companies that were providing Netflix and like some of the online shoppings, the Amazons, but the vast majority, GDP globally, was going down the toilet. We didn't have a vaccine and people were dying. People were dying and the market dropped 20%. And everybody said, But this time it's different. And yeah, it was different. Every time is different. And that's the part we need to get our heads around.
Yeah, every time is different and every future time is also going to be different. This is, just whatever has been happening over the last few days and weeks, we're going to experience something similar, not exactly the same, but something different along the lines of this time and time again. Andrew, I remember we did a webinar, myself and my colleague Faisal, in August of last year. In August, I don't know if you remember, I think it was August, and the only reason I remember is because I looked at some of the slides. It was August 5th of 2024. The market took a relatively steep drop. We made slides for a webinar, and maybe we did the webinar on, I want to say on August 9th. By the time we did the webinar 4 or 5 days later, the market was higher than where it was after. It felt so redundant doing this webinar. And I can guarantee you, if I ask even the people who attended the webinar, if they remember that drop in August, which wasn't even a year ago, I don't think they would have remembered it.
It's funny you say that because 1987, this would have been one of the times when a couple of friends of mine and I were first starting to get kind of interested in the stock market. So we were in high school, and in one day, the market dropped 22%. And of course, there were all these talk of Armageddon and the whole bit. Um, that year ended with an 11% gain.
Yeah, it's we're gonna experience this again, time and time again. We're gonna forget about the conversation me and you are having today because there's gonna be more, hopefully more important things also in your life and mind that you can focus on than just the drops. So wanted to, you mentioned this slide before. And I think we talk about this example a lot, and I think we've talked about it. I thought this would be a good place to end before we go into the Q&A. And I think it touches a lot upon human psychology with the stock market, and I think this image captures it perfectly. But the stock market is the only place, right, when people run away when prices go down. When we see discounts, imagine your shoes go on sale, you fill up the cart. When we see stocks that are cheaper, suddenly we panic. And I think it's important to try to flip that mindset.
Yeah, absolutely.
So okay, great. So I think we can move it on to the Q&A section. But actually, right before we move on to Q&A, I actually wanted to share a story. And I shared the story we had a webinar a couple of days ago, but I think, Andrew, you'd appreciate it as well. And this really goes to show that I believe that there has been a shift in the mindset of a lot of investors who've been investing for the last few years. So last week, right, it was Eid holidays here in the UAE, so a lot of people were off traveling, spending time with family. And whilst this is all happening, the markets are falling, right? This is last week. Headlines are everywhere. You hear about tech stocks going down and this spiking and this going down. And look, it's the week as an advisor when you say, look, you've got to brace yourself. And I remember waking up on Thursday, checking what was going on and saying, okay, this is going to be a day and a half, right? Phone's going to light up. It's going to go crazy. Because this happened in 2020, right? In COVID. We had questions. Should I sell everything? Is this going to be like '08? Should I wait, go into cash? Even in 2022, when this happened, there was market volatility. So we were already last week, waiting to see what's going to happen with clients and wait to see what investors are going to be sending through. But honestly, there was nothing. There was no panic. There was no flood of messages. Phone didn't ring. The inbox was relatively calm. The difference was this time we got some messages, but saying, okay, is this a good opportunity potentially to add more, or I've got a bonus coming in, I'm planning on deploying it. So I was honestly stunned. I think the mindset has changed for a lot of people, and not just on holding on, but and not just avoiding panic, but actually understanding that there is opportunity here. And I know JP Morgan, they also released an article saying that retail investors are buying stocks at higher levels than ever in the last 10 years. In 10 years, that includes COVID, rate hikes, war, AI hype, all of these different things. So I feel like it's a big deal. It's a signal. I think that the investor mindset has changed quite a lot over the years. Look, there's obviously always going to be the newer investors. Some obviously did reach out about the market volatility, but super impressed with the way that things have shifted. And I think a lot of it is to do with investors really gearing up and educating themselves.
You know, it's interesting. I'm actually gonna counter that, but I'm gonna actually give you a compliment at the same time.
Yep.
So the market volatility, the crazy swinging that we have is proof that no, humans are humans and we're as rational as crazy. We moved that. We moved the up, we moved the down. We did that. Humans did that. Human emotions are going to be human emotions, but in pockets, there are pockets where if we can educate people. So if you take an example of in 2008, when markets dropped, there was only one fund company in the United States that actually had net inflows. And it's a company called the Dimensional Fund Advisors.
Yep.
Vanguard had everybody had redemptions, net redemptions, except for Dimensional Fund Advisors. And the reason they had net inflows is they'd spent so much time educating constantly their financial advisors and in essence the people that invested in those funds on how to behave as investors. And you've done that obviously with things like this, right? And so as a result of that, it's showing that if you guys have net inflow, I'm going to tell you, actually, that's not normal. Like you can see it by the volatility. That's not what people have done. People have not been calm. They've been bat poop crazy, and you can see it through the volatility.
And look, I would love to take credit for it, but I think the client base and our investor base has really been very diligent with their investing. I think a lot of it is to do with education. So glad to see that's been happening. Uh,
Yeah.
Amazing. So let us move into Q&A. I think we've got quite a few questions that have come through. Okay, amazing. So Andrew, we've got a question here from Mohammed, who said that, Andrew, you often emphasize the importance of diversification. My question is specifically about real estate. If somebody has a significant portion of their portfolio in real estate, does it ever make sense to gradually shift some of that into global stock ETFs, especially when the stock market experiences a noticeable dip? And he's also said that I understand that we don't promote market timing, but could this be considered a form of intelligent rebalancing?
Well, I don't know about intelligent rebalancing as much as just diversifying further, and that diversifying further can be intelligent. But at the same time, as much as I don't actually own any real estate myself at this point in time, but I do know that there are people that have real estate as their circle of competence, and they're really good at finding cash flow positive real estate because real estate, basically buying properties, is a business. A lot of people don't treat it as such, but they should. Like, what's the cash flow? What am I paying for it? What's the yield on it? And if you're really good at sleuthing out those sorts of opportunities with real estate, and two, you're buying them in different places. So you're not just tied to the economy of Dubai. You have perhaps another region that you're really familiar with, and it might be a city in Spain. You're diversifying through that process there as well. So do you actually need to diversify into stock and bond market investments? Well, not necessarily. But if you do have some cash and if there is an opportunity, then I like the way you're thinking in that it is always better to be greedy when others are fearful and fearful when others are greedy.
Yeah, I love that answer. Just to echo it, right, Mohammed, also great question. Because it's usually, I think a lot of people think about it the opposite way, to maybe invest in equities and then maybe move that into real estate. But I like the mindset of it. But it's gonna ultimately depend on what your comfort level is, but diversification should be the forefront of any investment and investment portfolio. Okay. Great. So we have a question here from Wasim. Wasim has said, I am due for my monthly investment on the 20th of April, but I had FOMO when the market dipped the past 2 days. How do I know when it's best to buy a dip? I didn't invest and missed on an 8% increase.
Well, Wasim, just add money as soon as you have it, whenever you have it.
Yeah. Wasim, look, it is impossible to determine that we were going to have that 8% increase. It is, it could have continued. There's no way to really determine exactly what's going to happen with the market. If you're due to invest on the 20th of April, continue to do it. Do it every single 20th of April. Don't worry about what's happening in the market in the meantime. The likelihood is in 5, 10, 15, 20 years from now, you're going to be in a really good position. And also it's going to be hopefully a lot less stressful of an experience too. Okay, question from Mohammed asking, will you consider current market as a dip after the market is back up after the announcements of yesterday?
Would I actually consider it a dip currently at the current level?
Yeah, I think that's what the question is.
You know, I think one of the things that I will say is that one of the reasons why it's so good to be so globally diversified is the US stock market, it's based on fundamentals, it's actually pretty expensive, even with that dip. So it's not only the fact that even with the dip that we had over the last 5 years, the US market is up 109% with that drop. It's up 109% over the past 5 years with that drop. And it's not only the fact that the price to earnings ratio is far above the norm for US stocks. So I wouldn't say it's not a 2008 kind of discount. It's not a 2003 kind of discount, but we don't know that it won't continue to get more expensive. We don't know that we've seen a new level, a new norm for price to earnings ratios for the market as a whole. And I think too, the other level of that is one of the reasons why it's so important not to chase whatever market's doing really well or what has done well over the past 5 or 10 or 15 years is looking at if we're globally diversified. When we talked about that dip and when the European markets started dropping, and when the international markets and the emerging markets, holy smokes, now those are discounts. Those are serious discounts. And so I'm not saying, you know what, just start loading up on those. I'm saying we cannot see the future. But what we do know is that globally, half that market on a fundamental level is an incredible discount. The other half, we don't know if it will just continue to rise and hit new price to earnings levels. And so the idea of it, whether is it cheap, is it not, I think it's mostly irrelevant. I just come back to that main point. And that main point is invest money as soon as you have it, whenever you have it.
Great. Thank you for that, Andrew. And thanks, Mohammed, for the question. It's got Joe asking a question. So what happens in the case of war? How does the stock market react? So I can take, the initial of this, and Andrew, if you want to add anything as well. So Joe, it's with the stock market, as we've seen historically, the stock market hates uncertainty. I think war causes a lot of uncertainty. And I think when we look back at some of the more recent conflicts that we've seen that there, especially with what's happened with Russia and Ukraine, there was a lot of, I'd say some volatility at the time. But then you look back and there's certain wars where it hasn't impacted the market really at all. So it's very difficult to determine exactly what's going to happen with the stock market as a case of war. It's also at times even more difficult to predict exactly, when countries are going to go to war or the reason why they might go to war. In historically, when we look back at a lot of the, World War I, World War II, a lot of the Korean War, major war events, markets have potentially taken a bit of a dive, but historically they've rebounded quite significantly, and a lot of times they've rebounded even more significantly following some of these events. But overall, it is very difficult. I'm not sure if if Andrew, if you have any examples on specific wars and how markets have reacted as a result of them. But yeah.
Yeah, I do actually. So with the Korean War, there was an initial drop. It was fairly short term, and then the markets went haywire. With the Vietnam War, it was again an initial drop, and then the markets went up, and then they fell after that war actually ended. Actually, in 73, 74, the markets dropped. Then, like you say, back to your point, actually, there's not a lot of rhyme or reason. What brought the Great Recession, the Great Depression to an end was actually World War II. It just got the economic engines up and firing as people started building things. Those things weren't necessarily productive for good means, but that's what ended up happening. But it is so incredibly unpredictable. Generally, in the very beginning, there's fear and the market drops. Generally, there's a far stronger rebound historically. And we have to be really careful about cause and effect here. Just because we might have 7 or 8 examples and start saying, well, this causes this to happen. I bring it right back down, not to economics, but to human emotion, and humans move the stock market. I'll say that again. We move the stock market. You, me, and all the other investors. When it's volatile, it's because we are buying and selling and freaking out. When markets drop, if there's a war, it's because we are freaking out. And often there's a result of when markets drop the hardest. And this is an interesting point. Kenneth Fisher talked about this, and I think it was in his book Debunkery. And he said, it's often when we are most emotional, when markets drop the fastest, they usually rebound the fastest as well, because we emotionally, when we freak out, we always are far more afraid than often is justifiable. And then when we kind of collect our senses, the markets and our optimism ends up shooting it right back up again. You guys, it's not the economy that moves the market. It's our behavior. And we, you, me, the institutional traders, we are irrational short term. Take advantage of that.
Thank you, Andrew. So we got a question here from Divya, or a comment. Divya saying, thank you so much for the session. Definitely helped to calm some anxiety over the news of the past few days. I wanted to ask, do we have access to financial advisors through Sarwa? Oh, Divya, yes. Thank you for obviously attending the session. What you do, and let me just send you my email over here, and just feel free to send me an email, and we'd be more than happy to have a discussion with you. So I'm just going to send that across to you now. Got another question over here. So Anonymous is asking, we used to see Bitcoin highly correlated to the stock market, but it seems like it isn't the case anymore. We didn't see a big drop in Bitcoin, even though it is used to be considered a risky asset. What do you think is the reason? So Anonymous, with cryptocurrencies, this is such a new asset class, and I think the fundamentals behind it isn't necessarily as clear and concrete. I think historically, a lot of people thought that crypto assets would negatively correlate with more traditional asset classes. I think we've seen that not necessarily to be the case. I know that when equity markets dropped a couple of years ago is when, in 2022, and then crypto took a big hit as well. Things went back up with crypto. So it's actually, we've kind of seen it correlate a little bit more with the stock market. But yes, maybe in the last few days when the stock market went down as quite severely, crypto assets did not go down as severely as the stock market did. But it's very difficult to pinpoint what the reason for that is. I think a lot of people, economists and analysts, were speculating to say that, look, the Trump administration was very favorable towards cryptocurrencies. I believe that there was a crypto czar that was put into place as well. And I think that's one of the big reasons why we saw the price. But a lot of it is just speculation, at the end of the day. So it's very, very challenging to determine exactly, what the reason for that might be. And yes, it is, obviously a risky asset, but for a lot of people, that's proven to serve some opportunity too. So got a question here from Joe. Do you recommend I buy stocks if I'm planning to pull out the money in less than a year?
No. So Joe, yeah, there's a general rule of thumb. A general rule of thumb is that we don't put anything in the stock market that we'll be needing in its entirety within a 5-year period, because markets can drop and it could be lower. And if you need all of that money within a 5-year period, then you don't necessarily have time to wait out what might end up being, would inevitably end up being a recovery for the markets.
Yeah, Joe. So, I mean, look, the best thing to do would, for anything that's less than a year, have it in a savings account, high yield savings account, even better. But make sure that you have access to it. Make sure there's liquidity with that as well. Investing in the stock market, if you go through drops, which you most likely will in a year's period, you don't want to be in a position if you definitely need that money. Okay, just got a question over here. So Anonymous is asking, Sarwa's portfolios are all heavily weighted to the US market, and assuming the tariffs are here to stay to some extent, would that prompt changes to increase the portion of international ETFs? So look, really interesting question. So look, the Sarwa Invest portfolios and our investment committee and then the portfolio construction team, they approach it in a completely non-speculative way. The Sarwa Invest portfolios are passive, and they follow more of what's called a market capitalization approach. Now, the reason why they're more heavily weighted to the United States is because the US economy is the global economy. It represents around 50% of the economy. So that's the reason why the equity allocation is, in that place. Our team is not going to be reacting to anything short term to change the overall portfolio construction, because that sort of defeats the purpose of, the sort of passive investment philosophy. Now, if for whatever reason that means that the US economy starts to shrink really significantly over, the few years, then naturally that would be the case. We would start to, naturally the portfolios would change and the allocations would change. But just based on what happened with the tariffs, and I know the question was about the tariffs, no, I don't think we would make any changes, because look, if you just see what happened yesterday, the tariffs were put on pause for 90 days, the market went soaring. Who knows, what's going to happen in the next 3 months. So we don't want to make any quick decisions. Okay. Got a question. Somebody's asking, I have a big chunk of cash available right now. Should I average it out or pump it in one go, since it's a discounted market?
In most cases, when we're looking at adding money all at once or dollar cost averaging it over a series of months, in most cases, historically, over a 10-year period, just about 70% of the time, it ends up being better. You end up being better off for having more money, having invested that money all at once. So time in the market tends to be the most powerful propulsion for your future wealth. There's no guarantee. And so there's that element, though, that, if the market's dropped and you felt regret, like if you're the sort of person too, if you put money in the market, it's a big lump sum and it dropped, if you're the sort of person that's actually going to feel regret to the point where you might actually sell. If you think that that's your personality, then say, okay, the odds aren't as good that I'll have as much money by dollar cost averaging it in over, maybe I'll put a chunk in per quarter over 4 quarters or whatever. But you have to recognize your human limitations with respect to your personal emotions. And if the answer is that a market drop would freak you out, then yeah, you might be that person that perhaps should take that chunk and put it in quarterly over the next year. There's another way of all really reframing this, because so many people will ask me this question and they're like, hey, Andrew, I just sold a house. Should I put it in now? Is it a good time to put it in now? That is exactly the same as that person asking me this. Hey, Andrew, I know that you have been adding to the market for years. You've got several $1 million in a diversified portfolio of ETFs. Should you sell everything now because there's volatility? Is it a good time for you to sell everything and then re-enter the market maybe in a few months and chunk your portfolio in to add it quarterly? When you rephrase it that way, most people go, well, no, I would never ask Andrew to do that. It doesn't make any sense. Andrew have to keep his portfolio there and he just have to keep, he keeps adding money to it. It's the exact same question mathematically, just asked by looking through a different lens.
Yeah, and it's a great answer, and it's also a great question because we get it all the time. I think a lot of people do come into money, bonuses, potential inheritances, whatever it might be. It can be quite overwhelming to receive such a large lump sum. And I know the person who wrote the comment said relative to their income, it can be pretty overwhelming to just suddenly receive a huge lump sum. According to the data, as Andrew said, putting that lump sum in, letting it appreciate over time, you're going to be in a fantastic spot. But if that, if overnight the market does drop and that volatility causes you stress, you're going to be in a better position to average it out. So have a think about what you as an individual, and how you would react. And I think you will know the answer. So I know that we're getting right to the end of the session. So maybe one last question. Abdullah's asked, since the US market started slowing down a couple of months ago, a lot of investors resorted to commodities like gold, making gold hit record highs. Should more passive investors, such as myself, be distributing my capital across commodities, ETFs, and bonds?
I think Abdullah, the important thing here is that you establish a consistent allocation and maintain that allocation. And so if you have an allocation of 70% global stocks and 30% global bonds, if that's your allocation, maintaining that will actually see you buying the laggard. It will see you buying that which is not doing as well. And so, what's instinctive for people is they'll see that gold has gone up and stocks have gone down. So, they'll decide, I'm going to add gold. Now, this is the absolute opposite of what we should be doing. So, if you're the sort and you're like, I want to have a portion of gold in my portfolio, if that's you, then keep a portion, 10%, 15%. If that's you and you really want that, then keep that. And you know what will happen is when gold drops, if you have that set allocation and you decided I'm going to be consistent with 15% in gold, when gold drops, then you'll be adding fresh money to gold to make sure that you are maintaining that 15% allocation. And that's the secret to one, reducing risk, and two, not chasing the rising asset class perpetually with fresh money. That's what most people do, and you don't want to do that.
Amazing. So we actually do have a comment, not a question. Somebody has said, "Hey Andrew, are you working out? You're killing it."
Well, I mean, I'm just sitting here in a sweater, but thank you. I really appreciate that.
You've got some fans. But everybody, look, thank you so much for joining us today. Andrew, a huge thanks to you for sharing your time, sharing your wisdom. Really appreciate it. I think for everybody in the audience, look, remember that market drops are not necessarily the enemy. They can be a great invitation. But as always, if you have any questions, you want to speak further, don't hesitate to reach out after the webinar. I think for everybody, stay the course, stay diversified. And Andrew, once again, thank you so much for your time.
My pleasure. Thanks, Akshay.
Okay. Thank you, everybody. Good night.